what's up guys, it's Jonathan here. So with 2021 quickly ended and us moving into 2022, I thought that this would be a really good time to talk about some important things that we need to watch out for in the markets moving forward. So in this video, we'll discuss 4 important things to watch out for in the market in 2022. The goal of this video isn't to spread FUD, but just to make some awareness of some of the things that I see forming in the market next year. So if this video provides you any value, please consider hitting the like and subscribe button. They both greatly help out the channel. They help push this video out to as many people as possible. So let's get right into it. The first thing you should watch out for in the markets is inflation. At the most recent FOMC meeting, the Fed stated they plan on doubling the rate of the taper and completely ending the taper at the end of March. And the Fed also plans on increasing interest rates 3 times in 2022. During the FOMC press conference, Jerome Powell was asked if time was needed between the end of the taper and the first rate increase, where he responded saying that there wouldn't need to be any lag. So we may see our first rate increase as soon as the taper is over. This meeting was a very stark change to the Fed's normal tone of saying that inflation is transitory. And they're starting to move away from the dovish stance on inflation and starting to take a more hawkish stance. Now, many people in the market believe that a lot of the inflation we're seeing is due to supply chain constraints and leftover stimulus money floating around in the economy. Things like the child tax credit and mortgage forbearance. There's also a very strong belief in the market that a lot of these supply chains will go back to normal in 2022. And with the recent news that we got that the Build Back Better plan might be in jeopardy, which included an extension of the direct child tax credit for 2022, the Fed may have slightly overreacted to the current inflation that we are seeing in the markets. And with their strong hawkish plan to fight inflation in 2022, there is some concern that this may end up causing deflation to occur next year, which hence would lead to a deflationary spiral occurring. And basically what a deflationary spiral is that when deflation happens, usually prices fall as the dollar becomes more valuable. And when the dollar becomes stronger, people start to value their cash more. So this means that the average consumer is more likely to hang on to their money, mostly because they think, oh, if I just wait a little bit longer, prices will fall even more and my dollar become more valuable. And when you have an economy that doesn't have money circulating through it, that usually doesn't lead to good things. So if people don't go to the store and make purchases, then that means that companies won't have the money to pay their employees. If companies don't have the money to pay employees, then they start to lay people off. If people get laid off, they don't have money to spend in the economy. And it's like this revolving circle. That's what they mean by the deflationary spiral. And it can be very difficult to break that chain. This is some of the reason why the Fed earlier on in 2021 had the stance of letting inflation run hot. Because it's much better to have inflation run a little hot versus having a little bit of deflation. Because a little bit of deflation can end up creating a lot of deflation. Also, throughout 2021, a lot of companies have had a hard time hiring workers. And to fill in the productivity gap, a lot of these companies turn to the strongest deflationary force in the modern world that we have, which is technology. So back when I was in college, I actually used to work at Walmart. And I remember when I worked there, we had 18 like normal cash registers, and then we would have like 6 self-checkout cash registers. Well, I just went to Walmart just recently and actually saw the exact opposite. The Walmart that I went to, it only had about 5 or 6 manned stations, and then the rest of them were all self-service kiosks. And the reason why I bring this up when we're talking about deflation, I believe that this store had about 10 kiosks. With those 10 kiosks, they only need 2 employees to watch over it. If they had 10 registers, then they would need 10 employees to operate all 10 registers. So because of this, Walmart is still, again, the same value, but they're paying less money for it, which is a productivity boost. And productivity boosts lead to deflation. I think if we do start to see a strong deflationary trend, the Fed will step in and act appropriately. It's not something that I'm super concerned about, but it's definitely something to watch out for in 2022. So the second thing to watch out for is interest rates. So at every FOMC meeting, the Fed comes out with something that they call the dot plot. Pretty much what the dot plot is that it shows the expectation for the Fed's fund rate from each FOMC member. And during the December FOMC meeting, most of the members expected the rate to be somewhere between the 0.75 to 1% range by the end of 2022. And for reference, currently that rate sits at 0 to 0.25%. And normally the Fed will either increase or decrease rates at 0.25% per each occurrence. So you usually won't see them go all the way from 0 to like 1 overnight. They'll usually gradually work their way up or down. So like I said before, this means that we should see free rate increases in 2022. And by raising rates, they're making the cost of borrowing money more expensive, which could be problematic for companies that have a lot of short-term debt on their books. There are some people in the market who don't believe that the Fed will be able to make all free rate increases in 2022. So this is something else that we should watch out for, because if the Fed isn't able to make all of these rate increases, it may not be as problematic as if they are able to. So just keep your eye out on that as well. The next thing that we should watch out for, and in my opinion, this is one of the biggest things to watch out for, is debt. And this kind of piggybacks on what I was talking about with the interest rates. And what we really gotta watch out for is debt levels. But debt levels with corporations, debt levels when it comes to margin, and debt levels when it comes to consumer debt. So when it comes to corporate debt, companies with a lot of short-term debt obligations will probably feel the pain of all the rate increases from the Fed. But given how transparent the Fed has been to the market, I don't necessarily think that this is going to become too much of an issue. The companies that are really deep in debt, it can become problematic. So hopefully these companies don't get blindsided by this, but if you are investing in companies that do have a lot of debt, you may want to watch out for this. Also, another sector of companies we gotta watch out for are growth companies or companies with high PE ratios. And the reason why is because when interest rates go up, it makes the value of today's dollars more valuable than the value of tomorrow's dollars. And because with growth stocks, you are investing in the future and you're investing in future profits, you can see some significant valuation compression happen when interest rates go up. So the second type of debt that we should watch out for is margin debt. And to make it simple, pretty much what margin debt is that it's debt against stocks or other securities that you own. In October, we saw a record high number in margin debt outstanding. And even now, we're not too far off of those levels. Personally, I like looking at margin debt just to see how frothy the stock market is. And with interest rates possibly increasing in the near future, I think that we'll most likely see a pullback in margin being used. And if we see this happen, we may see a slight pullback in the market. So it is something to watch out for. I'm not too sure how much it'll affect the market exactly, but something good to keep your eye out on. And if you're interested in tracking that, then you can just go on Google and type in FINRA margin debt, and it'll show you like a whole table of how much margin's outstanding for each month. So the last type of debt that we need to watch out for, and this is especially important if you're investing in a lot of consumer discretionary stocks, and that is consumer debt. So throughout 2021, generally speaking, the average American has felt pretty wealthy. Currently, the S&P 500 is up about 26% in 2021. And like I said at the beginning of this video, there's still a lot of stimulus money out there. You have to realize that people are still getting their child tax credit, which I believe is either free or $600 per child every month, which is a significant amount of money. And then also there's still people who are on mortgage forbearance who are able to put their mortgage payments at the back of their loans. So the average American household has a lot of discretionary income this year. When you combine this with the fact that people have been locked down for most, if not all of 2020, this fueled amount of discretionary spending. And as we start to see a pullback in stimulus programs, it's very likely that we're going to see people who want to keep up the same lifestyle they had in 2021 in 2022. And if they don't have the money to do so, the way they're going to do it is by taking on more debt. So we should watch out for a rise of consumer debt in 2022. So the fourth thing we need to watch out for in 2022 is advertising. So in 2021, many companies dealt with supply chain issues. And because of that, a lot of companies were not running ads for their products. Because what's the point of spending money on ads when you don't have any products to sell? The only point of that would be brand awareness, but a lot of the big corporations like Nike, they don't really need brand awareness. They need people to buy shoes. But in 2022, if we have supply chains start to clear up and we have consumers not having as much discretionary income as they do now, companies are going to be really driven to spend more money on advertising, especially given that they're going to be compared to 2021 numbers in 2022. So to attract more sales, I believe a lot of brands are going to start pushing massive ad campaigns. So to summarize all of this, let me tell you what my investment plan is next year. So when it comes to the stock market, I'm probably going to stay away from any companies that have a lot of debt on their books compared to the amount of cash that they have available. One good example of this is some of the airlines and recovery stocks. A lot of these companies have still yet to pay off their debt from 2020. So those kind of companies I'm staying away from. Another thing I'm going to stay away from is low or no margin companies. Now, just to make things clear, I am invested in a good amount of companies that have little to no profits. And I'm probably going to hold on to those stocks. Given the fact that we may see some deflation at some point this year, I think that those companies are not going to have the margin to be able to reduce their prices, which can really put them in a hard point where they may have to raise capital. And most public companies, they raise capital by diluting shareholders. And I personally don't want to be diluted. So I'm probably not going to be as aggressive to add to those positions this year. Generally, overall, I'm going to be very careful about when I buy stocks. I'm probably going to avoid buying stocks when things are running up and pretty much just only going to buy the dips. And that's mostly just because I feel like there's going to be a lot of valuation compression this year. So just to be on the safe side, I'm probably only going to be buying when the market is compressed. So for me, what I'm looking to buy is I'm looking to buy high margin growth companies. So companies like Tesla, Nvidia, Enphase, Etsy. These companies are already pretty big portions of my portfolio, especially if you've been checking our weekly portfolio updates. So I'm probably going to continue to add on to these positions. Also, another thing I like to buy is a lot of ad plays. So one of my favorite stocks that's not only a growth play, but it's high margin and it's an ad play is Google. So I'm probably going to be adding quite a bit to Google this year over time. There's some other ad plays as well, like Trade Desk, Facebook. So I'm going to be looking for a lot of those advertising plays. So when it comes to real estate, I think that the real estate market will face some headwinds when it comes to rising interest rates, which will probably bring the prices of homes down a bit. Personally, in my market, we have such a supply problem. I really don't think that interest rates are going to affect the market too much. So I'm probably going to still keep my eyes out for a good below market deal. So when it comes to cryptocurrency, I think that it's going to face some headwinds as we start to see inflation start to deflect downwards. But I think that 2022 can definitely be the year of cryptocurrency. I know some of the crypto bulls that follow me are not going to like what I have to say, but I think that if we could get some clear regulatory guidance from whether that be the SEC or Congress or whoever, I really think that crypto would do very well. That'll make a lot more institutional investors more comfortable in investing in Bitcoin and Ethereum and all these other cryptocurrencies. So I have a 5% rule where I don't let cryptocurrency make up more than 5% of my portfolio at any time. This year, I was pretty loose about it. Anytime crypto ran, I kind of just let it sit. But going into this year, I'm probably going to be a lot more strict with that 5% rule. If we do see any runs, I probably will be selling. If we see any dips in the market, I probably will be buying. I'm going to hold pretty strong to that 5% rule. But overall, I think asset markets, whether that's crypto, real estate, stocks, I think it's all going to do very well when we get more clarity on COVID, crypto regulations, and inflation. So I'd like to thank you guys for watching. If you enjoyed this video, please hit the like button for your YouTube algorithm. Greatly helps out the channel, helps push this video out to as many people as possible. If you enjoy my perspectives and the way I explain things, consider hitting the subscribe button and notification bell so you get notified anytime I post a new video. Let me know what you guys are looking at for 2022. Is there any particular stocks you're looking at? Is there anything that you think will happen in the market? Let me know in the comment section down below. I would love to hear from you guys. Also, follow me on all my social medias. I try to post there every day. And thank you so much for watching. I'll see you in the next video.